Well, it is time for your markets update. The local bourse facing mixed markets on Tuesday morning, with sentiment lifted a little by the prospect of the U.S. easing of tariffs on Chinese goods. Gary Booysen is portfolio manager at Rand Swiss, joining us now to help us make sense of the latest market moves. Gary, good morning to you. Your quick sense of how the markets have opened this morning after ending in the green in the last session for the first time in 4 sessions.
I wish I could say that the optimism in financial markets was continuing, but unfortunately we had the S&P 500 closed for that 4th of July Independence Day holiday, and it seems to be some of the positivity is now unwinding. So while Asia did have a positive session, it did come off its highs towards the end. The All-Share Index at the moment down 0.2%, and really the brunt of the pain being felt in the resource sector, which is down 1.5% today, being led low by the likes of Anglo-American Platinum, Anglo-American, the underlying company, Zimbabwe, all over 2% down at least. We are seeing the industrial index bucking the trend, so that's up 0.2%, but it's really being driven by Naspers and Prosus, which if you look at the Prosus listing, that up 2.65% at the moment. That would just be, I suppose, on the optimism of the deal announced by Bob Van Dijk and the team last week around the financial engineering that they're pursuing to narrow the discount to their underlying asset, Tencent. But overall, you're seeing a little bit of positivity creep into the currency. So we've seen the rand actually strengthening against the US dollar, coming down to around 16.22 at one point, but a little bit volatile today. And I think everyone waiting to see what happens later in the week with the FOMC minutes and those non-farm payroll numbers on Friday.
Gary, you're not the bearer of good news, not quite. There doesn't seem to be an anchor, though, left for Turkey's inflation. Gary, it's nearing the 80% mark. Talk us through the developments there and what the major concerns are.
I suppose good news and bad news is all relative. So the good news is that our central bank is much more responsible than the Turkish central bank. So, what's happening in Turkey at the moment is, the President Erdogan has said that interest rates, he's quoted as saying, are the mother and father of all evils. So what happened a little while ago is in the face of rising inflation, the Turkish central bank decided to cut interest rates, which is obviously counter to what any central bank would do in that environment. When you have, at least in the face of rising inflation. So when you have the rising general price level, the natural response is to rise interest rates, cool the economy, and essentially protect the currency and protect yourself from hyperinflation. So as they did the opposite, their local interest rate was at 19%, they cut it to 14%, and what this fueled was just an absolute crash in the lira. Obviously when your currency crashes, it does help you a little bit with tourism, as people look at Turkey and say, hey, in summer we might go to Turkey and have a cheap holiday. The problem is that you also import all sorts of inflation into the country as well. And that's what we're seeing in these June numbers, up 78.62%. So if we thought inflation was bad in South Africa, just outside our target band at just above 6%, at least we're not Turkey.
Well, let me tell you about one country whose inflation has been in the news for most of the years, as I've been reporting as a journalist. Zimbabwe. The central bank there planning to sell gold coins to the public from the month of July and the 25th, to be specific. What does that tell us about that country's economy, and is this decision even feasible?
Well, I think it is feasible. So, you look at it when, if you go back to the history of currencies, the US dollar used to be, linked to gold. The South African rand used to be linked to gold. And the idea of removing essentially the gold standard from a currency was to take more control as a central bank. So more control over, essentially the circulation of currency in an economy. And that allows you to do all sorts of interesting things to stimulate growth, but only if you're very, very responsible. And unfortunately, it's often too tempting for central banks to use this power irresponsibly. And what happens then is you get hyperinflation, as we've seen in Zimbabwe, as we're seeing in Turkey. And I hate to say it, as we're starting to see in the US as well. So we had Jerome Powell come out the other day and say that he's starting to understand how little he understands about inflation. And that's a terrifying thing for for essentially the central bank governor of the world's reserve currency, which is the dollar, to say. So the idea of going back to a more basic terms, a basic form of monetary exchange, which is something like using physical gold, is not unprecedented. It's actually not a bad idea. What you lose when you move to essentially linking transactions to currency is the ability to almost match your money supply to the underlying level of economic activity. But it's almost a move of last resort to try and stabilize an economy and provide a store of value and a medium of exchange to citizens in Zimbabwe. So looking at the gold coins, I don't think it's a particularly bad idea. Obviously dollars are in short supply, and also the way that they're doing it is interesting because the coin is actually going to be linked to a serial number for identification. It's a 22-carat coin, so very similar to the South African Kruger Rand, and it will essentially give people in Zimbabwe an option to store value when they're facing inflation at 192% last month. So.
Well, that's exactly the point. When I started asking you about Zimbabwe, inflation in that country has just been skyrocketing. Let's end the conversation, Gary, with a bit of company news. Elesys, which imports and makes and sells electronic equipment, says it's betting on solar power equipment and generator sales to turn its fortunes around. Question to you, is solar going to be the new normal?
I hope it's not going to be the new normal, in that I hope that we don't stay at level 6 load shedding indefinitely. So, you look at the idea that we've seen obviously significant strain on the electricity grid at the moment, thanks to the Eskom wildcat strike, and there's no question that our grid is under an enormous pressure. Now, you would tend to hope that we can have a central kind of electricity distribution system. If we are building new capacity, I think the idea of using renewables, specifically solar in South Africa, is a very good idea. The problem is kind of the implementation. Now, what Elesys is trying to do, obviously, is give the solar panels for private homes and private citizens, and allow everyone to kind of be their own little power station, which is obviously not the most efficient way of doing things, but unfortunately is the reality for people living in South Africa. And looking at the plans at Eskom, it seems like load shedding is not going anywhere. We've had it for decades, and unfortunately it is a reality that Elesys is just stepping into a gap where Eskom has failed.
Gary Booysen, let me thank you very much for your time and indeed that markets update. He is Portfolio Manager at Rand Swiss.